I am here to give you a brief introduction of accounting. So we will be going through some basic concepts of accounting. So let's move. So here is a brief introduction of accounting. Over the centuries, accounting has remained confined to the financial record-keeping functions of the accountant. But today's rapidly changing business environment has forced the accountant to re-access their roles and functions both within the organization and the society. The role of an accountant has now shifted from that of a mere recorder of transactions to that of the member providing relevant information to the decision-making team. So broadly speaking, accounting today is much more than just bookkeeping and the preparation of financial reports. Accountants are now capable of working in exciting new growth areas such as forensic accounting, e-commerce, financial planning, environmental accounting, etc. Here is a brief definition of accounting. According to American Institute of Certified Public Accountants (AICPA), defined accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. What are economic events? See, business organizations involves economic events. An economic event is known as a happening of consequence to a business organization which consists of transactions and which are measurable in monetary terms. For example, sale of merchandise to the customers, rendering services to the customers by ABC Limited. It can be internal event or an external event. If an event involves transactions between an outsider and an organization, these are known as external events. Or it can be internal event, such as when it occurs entirely between the internal wings of an enterprise. Example, supply of raw material or components by the store department to the manufacturing department, payment of wages or salaries to the employees, etc. So, here we'll be dealing with the scope of accounting. Identification. It means determining what transactions to be recorded. That is to identify events which are to be recorded. It involves observing activities and selecting those events that are of considered financial character and relate to the organization. The business transactions and other economic events, therefore, are evaluated for deciding whether it has to be recorded in the books of accounts. For example, the value of human resource, changes in managerial policies, or appointment of personnel are important, but none of these are recorded in the books of accounts. However, when a company makes a sale or purchase, whether of cash or credit, or pays salary, it is recorded in the books of accounts. Then it is to be measured, which means quantification including estimates of business transactions into financial terms by using monetary unit. For example, rupees and paise as a measuring unit. Then these are to be recorded accordingly once the economic events which are identified and measured in financial terms, these are to be recorded in books of account in monetary terms and in chronological order. And finally, the economic events that are identified, measured, recorded in order that the pertinent information is generated and communicated in certain form to the management and other internal and external users. The information is regularly communicated through accounting reports. These reports provide information that are useful to a variety of users who have an interest in accessing the financial performance and position of an enterprise, planning and controlling the business activities, and making necessary decisions from time to time. Organization. Organization refers to a business enterprise whether for profit or not for profit motive. Depending upon the size of activities and level of business operations, it can be sole proprietary concern or it can be partnership, cooperative society, company, local authority or municipal corporations. So, who are the interested users of information? Here are top 10 users of financial statements, such as management of the company, investors, customers, competitors, government and government agencies, employees, investment analysts, lenders, rating agency, suppliers. Accounting as a source of information. Accounting is a definite process of interlinked activities that begins with the identification of transactions and ends with the preparation of financial statements. Every step in the process of accounting generates information. Generation of information is not an end in itself. It is a means to facilitate the dissemination of information among different user groups. Such information enables the interested parties to take appropriate decisions. Therefore, dissemination of information is an essential function of accounting. To be useful, that accounting information should ensure to provide information for making economic decisions, serve the users who rely on financial statements as their principal source of information, provide information useful for predicting and evaluating the amount, timing, and uncertainty of potential cash flows, provide information for judging managerial ability to utilize resources effectively in meeting goals. So here are some of the qualitative characteristics of accounting, such as reliability, relevance, understandability, comparability. Reliability, which means the users must be able to depend on the information. The reliability of accounting information is determined by the degree of correspondence between what the information conveys about transactions or events that have occurred, measured, and displayed. A reliable information should be free from error and bias and faithfully represents what is meant to represent. Relevance. To be relevant, information must be available in time, must help in prediction and feedback, and must influence the decisions of users by helping them form predictions about outcomes of past, present, or future events and or confirming or correcting their past evolutions. Understandability, which means decision makers must interpret accounting information in the same sense as it is prepared and conveyed to them. The qualities that distinguish between good and bad communication in a message are fundamental to the understandability of the message. A message is said to be effectively communicated when it is interpreted by the receiver of the message in the same sense in which the sender has sent. Accountants should present the comparable information in the most intelligible manner without sacrificing relevance and reliability. Comparability. It is not sufficient that the financial information is relevant and reliable at a particular time, in a particular circumstance or a particular reporting entity, but it is equally important that the users of the general purpose financial reports are able to compare various aspects of an entity over a different time period and with other entities. To be comparable, accounting reports must belong to a common period and use common unit of measurement and format of reporting. So, this is a flowchart describing qualitative characteristics of accounting. These are some of the basic accounting terminologies. Accounts payable. Accounts payable includes all of the expenses that the business has incurred but not yet paid. This account is recorded as a liability on the balance sheet as it is a debt owed by the company. Accounts receivable. Accounts receivable include all of the revenues, sales that a company has provided but not yet collected payment on it. This account is on the balance sheet recorded as an asset that will likely convert to cash in the short term. Accrued expense. An expense that has been incurred but hasn't been paid is described by the term accrued expense. Asset. Anything that company owns that has monetary value. These are listed in order of liquidity from cash, the most liquid, to land, least liquid. Balance sheet. A financial statement that reports on all of company's assets, liabilities, and equity. Equity. Equity, which denotes the value left over after liabilities have been removed. Recall the equation assets equal to liabilities plus equity. If you take your assets and subtract your liabilities, you are left with equity, which is the portion of the company that is owned by the investors and owners. Inventory, which is a term used to classify the assets that a company has purchased to sell to its customers that are remain unsold. As these items are sold to customers, the inventory account will lower. Liability, all debts that a company has yet to pay are referred to as liabilities. Common liabilities include accounts payable, payroll, and loans. Income statement. The income statement or profit and loss account is the second of the two common financial statements. Some of the terms that are most commonly used in reference with this reporting tool are cost of goods sold, COGS. Cost of goods sold are expenses that directly relate to the creation of a product or service. Not included in this category are those costs that are needed to run the business. An example of the COGS would be cost of materials or the direct labor to provide a service. Depreciation. Depreciation is a term that accounts for the loss of value in an asset over time. Generally, an asset has to have substantial value in order to warrant depreciating it. Common assets to be depreciated are automobiles and equipment. Depreciation appears on income statement as an expense or is often categorized as non-cash expense since it doesn't have a direct impact on a company's cash position. Expense. An expense is any cost incurred by the business. Gross profit, which indicates the profitability of a company in dollars without taking overhead expenses into account. It is calculated by subtracting the cost of goods sold from revenue for the same period. Income statement, profit and loss or PL account is the financial statement that shows the revenues, expenses and profits over a given period of time. Revenue earned, which is shown at the top of the report, and various costs are subtracted from it until all costs are accounted for, the result being net income. Net income is the dollar amount that is earned in profits. It is calculated by taking revenue and subtracting all of the expenses in a given period, including COGS, overhead, depreciation, and taxes. Net margin is the percentage amount that illustrates the profit of a company in relation to its revenue. It is calculated by taking net income and dividing it by revenue for a given period. Accounting period. Accounting period, which is designated in all financial statements, income statement, balance sheet, statement of cash flows. The period communicates the span of time that is reported in the statements. Allocation. The term allocation describes the procedure of assigning funds to various accounts or periods. For example, cost can be allocated over multiple months, like in the case of insurance, or allocated over multiple departments, as is often done with administrative costs for companies with multiple divisions. Business entity or legal entity. This is the legal structure or type of business. Common company formations include sole proprietor, partnership, limited liability corp, S corp, C corp. Each entity has a unique set of requirements, laws, and tax implications. Cash flow is the term that describes the inflow and outflow of cash in a business. The net cash flow for a period of time is found by taking the beginning cash balance and subtracting the ending cash balance. A positive number indicates that more cash flowed into the business than out, where a negative number indicates the opposite. Credit Credit is an increase in a liability or equity account or a decrease in an asset or expense account. Debit, which is an increase, is an asset or expense account or decrease in a liability or equity account. Fixed cost. A fixed cost is one that does not change with the volume of sales. For example, rent and salaries won't change if a company sells more. The opposite of a fixed cost is a variable cost. Generally accepted accounting principles (GAAP), which is utmost important. These are rules that all the accountants abide by when performing the act of accounting. These general rules were established so that it is easier to compare apples to apples while looking at a business financial reports. Journal entries are updates or changes that are made to a company's books. Every journal entry must consist of a unique identifier to record the entry, a date, a credit or debit amount, and an account code that determines which account is to be altered. Overhead. Overhead are those expenses that relate to running the business. They do not include expenses that make the product or deliver the service. For example, overhead often includes rent and executive salaries. Trial balance. Trial balance is a listing of all accounts in the general ledger with their balance amount, either debit or credit. The total debit must equal the total credits, hence the balance. Variable cost. These are costs that change with the volume of sales and are opposite of fixed cost. Variable cost increase with more sales because they are an expense that is incurred in order to deliver the sale. For example, a company produces a product and sells more of the hot product, they will require more raw materials in order to meet the increase in demand. Depiction of financial position. Balance sheet. A balance sheet reflects the financial position of an organization. It is a statement of assets and liabilities. It shows the assets owned by the organization and depicts the liabilities against the assets. The balance of assets minus the external liabilities shows the capital. Cash flow statement. Cash flow, which is a term that describes the inflow and outflow of cash in a business, and when it is being recorded in a statement, it is called cash flow statement. The net cash flow for a period of time is found by taking the beginning cash balance and subtracting the ending cash balance. A positive number indicates that more cash flow into the business than out, where a negative number indicates the opposite. Income statements, often referred to as profit and loss or P&L account, is the financial statement that shows the revenues, expenses, and profits over a given time period. Revenue earned is shown at the top of the report and various costs or expenses which are subtracted from it until all costs are accounted for. The result is net income. I appreciate your time. Thanks for listening.